Deep trouble, but deep value. So we're looking at the chart of the week here, showing European equity valuations. So despite, or perhaps because of, all of the bad news and challenges and issues and threats facing Europe, an interesting development is showing up for a European stock market. The combined PE ratio, so the average of the forward PE, the trailing PE, and the PE10, so price to average trailing 10-year earnings, has dropped to extreme cheap levels. Now we use that combined ratio there just because it kind of brings together three different measures of the PE ratio with the hope or the intention of accentuating signal versus noise, because each of them has their own strengths and weaknesses. But anyway, the indicator is more or less on par with levels seen at the bottom of the dot-com bubble burst bear market and the 2020 pandemic panic crash. And that said, it has yet to plumb the absolute lows seen during the global financial crisis and subsequent European sovereign debt echo crisis. So therein lies one of their two cautionaries. Although it's cheap, it could get cheaper. So that's one. The other one is it should also be acknowledged that the E side of the PE ratio, earnings, is a moving target. So if earnings were to fall fast, and quite a good chance of that happening given the recessionary storm clouds on the horizon, then the valuation picture could seem a little bit less cheap than what they appear now. But practically speaking, rather than acting on valuation alone, and what's kind of alluded to there in the previous two statements is that if you only look at valuation, or one, you can kind of get into value traps, and two is that you can end up taking action perhaps earlier than optimal. But from our perspective, top-down charts would rather see a confluence of factors, so a full puzzle picture, basically looking at this chart as one puzzle piece, and our objective is to make a full puzzle picture with many pieces of the puzzle. So, cheap valuations is one, monetary easing would be another, better leading indicators, a sign of alleviation of those energy, geopolitical issues, macro turning back up, things of that nature, things that, by the way, have not yet fallen into place. So while the valuations at these levels do more accurately reflect or compensate for some of the risks, it may not be cheap enough yet to compensate for all the bad macro, global recession risk and such forth, at least in the near term. Further out, it could be a good point to start scaling in, which has historically been the case. So, something perhaps non-obvious, something that most investors would probably rather likely avoid, and certainly something to ponder, potentially place on the watch list. So the key point there is, as the chart shows, European equities are showing up as very cheap at this point. So if you enjoyed this, be sure to subscribe to the channel, but definitely also go over to topdowncharts.substack.com and sign up for the free chart of the week. I'll put the link in the description and comments as well.